Question 1. Which of the following statements best describes the key difference between proportional and non-proportional reinsurance? A. Proportional reinsurance involves sharing both premiums and losses between the ceding insurer and the reinsurer, while non-proportional reinsurance only involves sharing the premiums. B. In non-proportional reinsurance, the reinsurer covers losses above a specified threshold, while in proportional reinsurance, the reinsurer shares a portion of the insurer's losses based on a pre-agreed percentage. C. Proportional reinsurance is used for large-scale catastrophic risks, while non-proportional reinsurance is used for routine and day-to-day underwriting. D. Non-proportional reinsurance involves more direct involvement from intermediaries, whereas proportional reinsurance is negotiated directly between the ceding insurer and the reinsurer. Answer. B. In non-proportional reinsurance, the reinsurer covers losses above a specified threshold, while in proportional reinsurance, the reinsurer shares a portion of the insurer's losses based on a pre-agreed percentage. Explanation. Proportional reinsurance. This type involves a direct sharing of both premiums and losses between the ceding company and the reinsurer. The reinsurer accepts a fixed percentage of the premiums and losses based on treaty agreement. Common forms include quota share and surplus share treaties. Non-proportional reinsurance. This is typically used for larger or catastrophic risks. The reinsurer does not share in the losses proportionally but only covers losses above a specified amount. The attachment point. Common examples include excessive loss and stop-loss reinsurance. The reinsurer's liability starts once the ceding company's losses exceed predefined, making it less about proportional sharing and more about catastrophic risk management. Question 2. Mr. Jackson is the risk manager at a primary insurer. His company has been experiencing rising losses due to frequent, smaller claims and is looking for a way to manage these risks more effectively. What type of reinsurance would be most appropriate for Mr. Jackson's company? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Stop-loss reinsurance. D. Facultative reinsurance. Answer. C. Stop-loss reinsurance. Explanation. Stop-loss reinsurance. This type of non-proportional reinsurance is ideal for managing the cumulative effects of frequent, smaller claims. It provides coverage for losses that exceed a certain aggregate limit over a specified period, such as a year. This is especially useful in protecting against excessive losses from routine claims, which is exactly Mr. Jackson's concern. Excessive loss. Used for larger catastrophic risks where the reinsurer's liability starts after significant threshold of loss is exceeded, making it less suitable for managing frequent, smaller claims. Quota share reinsurance involves sharing fixed percentage of both premiums and losses with the reinsurer. While it provides proportional coverage, it does not specifically address the issue of excessive losses from smaller claims. Facultative reinsurance. This is purchased for individual risks on case-by-case basis, rather than for general portfolio risk management, making it unsuitable for the scenario described. Question 3. Which of the following best describes the role of reinsurance in managing underwriting risk? A. Reinsurance guarantees that all underwriting risks will be eliminated from the ceding insurer's portfolio. B. Reinsurance allows the ceding insurer to manage its risks by transferring a portion of them to another party, reducing potential financial instability. C. Reinsurance only covers large, catastrophic losses and does not provide protection against day-to-day underwriting risks. D. Reinsurance is primarily a tool for enhanced profitability of the ceding insurer by allowing them to assume more risk without consequences. Answer. B. Reinsurance allows the ceding insurer to manage its risks by transferring a portion of them to another party, reducing potential financial instability. Explanation. Role of reinsurance in underwriting risk. The primary function of reinsurance is to transfer risk from the ceding insurer to the reinsurer. By doing so, the ceding insurer reduces its exposure to large or unexpected claims, thus helping to stabilize its financial position. This is crucial for managing underwriting risk, especially when the insurer's portfolio is subject to high variability in claims. Eliminating risk. Reinsurance does not eliminate risk, but it helps to spread the risk across different parties. While reinsurance can reduce the financial burden of large claims, it cannot completely remove all risk from the insurer's portfolio. Catastrophic losses. While reinsurance can cover large catastrophic loss, it is not limited to just such risks. Reinsurance arrangements like stop-loss or quota share also help manage more frequent, smaller underwriting risks. Profitability enhancement. Reinsurance is not intended to enhance profitability by assuming more risk. Instead, it is a risk management tool to mitigate the potential impact of unforeseen or high-volume losses. Question 4. Which of the following is an example of facultative reinsurance? A. A treaty between a primary insurer and a reinsurer covering a portfolio of risks in a specific line of business. B. A ceding insurer buying reinsurance for a single large property risk to cover catastrophic damage. C. A reinsurer agreeing to cover a fixed percentage of every loss in a portfolio of policies. D. A reinsurer assuming a portion of losses based on a pre-agreed formula in the event of a catastrophe. Answer. B. A ceding insurer buying reinsurance for a single large property risk to cover catastrophic damage. Explanation. Facultative reinsurance. This type of reinsurance is purchased on a case-by-case basis for individual risks. The ceding insurer decides which risks to cede to the reinsurer, typically for large, unique, or catastrophic risks. In the example, the ceding insurer buys reinsurance for a specific large property, which fits the definition of facultative reinsurance. Treaty reinsurance. Unlike facultative reinsurance, treaty reinsurance involves a standing agreement covering a portfolio of risks rather than specific individual risks. Proportional reinsurance involves the ceding insurer sharing a fixed percentage of both premiums and losses with the reinsurer for all risks under the agreement. Excessive loss. This reinsurance covers only the losses exceed a specific threshold, often for catastrophic risks, but it is typically set up under treaty arrangements. Question 5. Which of the following is the most important factor in determining the reinsurance premium rate? A. The amount of capital reserves held by the ceding insurer. B. The historical claims experience of the ceding insurer's portfolio. C. The reinsurer's profit margin and operating costs. D. The geographical location of the ceding insurer. Answer. B. The historical claims experience of the ceding insurer's portfolio. Explanation. Claims experience. One of the most important factors in setting reinsurance premium rates is the claims experience of the ceding insurer's portfolio. History of frequent or severe claims would result in higher premiums, as reinsurers would need to account for the greater potential loss exposure of capital reserves. While the capital reserves of the ceding insurer influence solvency considerations, they are not the primary factor in determining reinsurance premiums. Reinsurers' profit margin. While reinsurers consider their profit margin when pricing reinsurance, they primarily base premiums on the risk presented by the ceding insurer's portfolio. Geographical location. While location can impact specific risks, such as natural disasters, it is the claims history and underwriting risk portfolio that more directly affects the premium rate. Question 6. Mr. Thompson works for a company that has a quota share treaty reinsurance agreement with a reinsurer. What is the primary characteristic of this type of agreement? A. The reinsurer covers losses that exceed a certain threshold in exchange for a percentage of the premiums. B. The ceding insurer and reinsurer share premiums and losses on a pro rata basis according to a fixed percentage. C. The reinsurer only covers a portion of losses from individual catastrophic events, leaving the ceding insurer responsible for the rest. D. The ceding insurer purchases reinsurance only for specific policies rather than a portfolio. Answer. B. The ceding insurer and reinsurer share premiums and losses on a pro rata basis according to a fixed percentage. Explanation. Quota share treaty. This is a proportional reinsurance agreement where the ceding insurer and reinsurer share both premiums and losses in proportion to an agreed percentage. This means that the reinsurer will take on a fixed portion of the losses corresponding to the percentage of premiums they receive. Excessive loss. Form of reinsurance is non-proportional, where the reinsurer only covers losses that exceed a specified threshold, not a pro rata portion of the entire portfolio. Facultative reinsurance. This type of reinsurance is not typically structured as a treaty, but rather on a case-by-case basis for individual risks. Surplus share. This form of proportional reinsurance also involves sharing a percentage of premiums and losses, but typically on specific risk limits per policy. Question 7. Which of the following statements about reinsurance collateral requirements in Maine is correct? A. Reinsurers in Maine are not required to post any collateral if they are licensed in the state. B. Collateral requirements are determined solely by the size of the ceding insurer's portfolio. C. Reinsurers that are not licensed in Maine must post collateral to secure their obligations to the ceding insurer. D. The Maine Department of Insurance automatically waives collateral requirements for international reinsurers. Answer: C. Reinsurers that are not licensed in Maine must post collateral to secure their obligations to the ceding insurer. Explanation: Reinsurance collateral requirements. In Maine, reinsurers that are not licensed in the state are required to post collateral to secure their obligations. This collateral acts as a safeguard in case the reinsurer defaults on its obligations. This rule is in line with ensuring the solvency and financial stability. Reinsurer from the perspective of the ceding insurer. Licensed reinsurers. If the reinsurer is licensed in Maine, collateral may not be required as the licensed reinsurer is considered to be financially stable under state regulation. Size of portfolio. The collateral requirement is not primarily based on the size of the ceding insurer's portfolio, but rather on the reinsurer's licensing status and financial health. International reinsurers. Maine does not automatically waive collateral requirements for international reinsurers. They are still subject to these requirements unless specifically exempted by law. Question 8. In the context of retrocession, which of the following is true? A. Retrocession is a form of reinsurance where the ceding insurer transfers risk to another insurer. B. Retrocession involves a reinsurer transferring part of the risk it has assumed to another reinsurer. C. Retrocession is a technique used by ceding insurers to avoid paying premiums to the primary reinsurer. D. Retrocession typically applies only to facultative reinsurance agreements. Answer: B. Retrocession involves a reinsurer transferring part of the risk it has assumed to another reinsurer. Explanation: Retrocession. This refers to the process where a reinsurer transfers a portion of the risk it has assumed from a ceding insurer to another reinsurer. This is done to manage the reinsurer's exposure to large or concentrated risks, providing additional protection through second layer of reinsurance. Reinsurance transfer retro does not involve the original ceding insurer transferring risk. Instead, it involves reinsurers managing their own risk portfolios. Premium avoidance. Retrocession is not intended to avoid paying premiums. It is a risk management tool to ensure that reinsurers can manage their exposure to significant risks. Facultative agreements. Retrocession is generally associated with treaty reinsurance agreements rather than facultative reinsurance, though occur in both contexts. Question 9. Which type of reinsurance is most suitable for covering the financial impact of catastrophic events that may affect an insurer's solvency? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Stop loss reinsurance. Answer: B. Excessive loss reinsurance. Explanation: Excessive loss reinsurance. This is typically used for catastrophic events where the reinsurer assumes responsibility for losses that exceed a predefined threshold attachment point. It is highly effective in managing the financial impact of catastrophic events as it provides coverage beyond the ceding insurer's retention limit. Quota share and surplus share. These forms of proportional reinsurance involve sharing premiums and losses based on a fixed percentage and are less suitable for protecting against catastrophic events that could drastically affect solvency. Stop loss. While stop loss reinsurance helps manage aggregate losses, it is more focused on controlling the overall exposure from frequent, smaller losses rather than catastrophic events that have a significant impact on solvency. Question 10. Which of the following best describes the concept of financial reinsurance? A. It involves transferring risk to a reinsurer in exchange for an immediate reduction in reported losses or expenses. B. It is used solely for catastrophic risks to provide coverage beyond the ceding insurer's retention limit. C. It focuses on reducing operational and reputational risks for the ceding insurer. D. It allows insurers to obtain regulatory capital relief by transferring risk to reinsurer with no actual transfer. Answer A. It involves transferring risk to a reinsurer in exchange for an immediate reduction in reported losses or expenses. Explanation: Financial reinsurance. This is a form of reinsurance that allows ceding insurers to achieve regulatory capital relief and immediate reduction in reported losses or expenses without necessarily transferring significant underwriting risk. It is often used as a financial engineering tool to improve the insurance balance sheet. Catastrophic risks. Financial reinsurance is not primarily designed for catastrophic risk management, but rather for improving the financial position of the ceding insurer. Operational and reputational risks. While reinsurance can help manage reputational risks, financial reinsurance is specifically focused on optimizing financial reporting, capital requirements, and solvency. No actual risk transfer. Unlike traditional reinsurance, financial reinsurance may involve minimal actual risk transfer, and its primary purpose is to allow insurers to meet regulatory capital requirements. Question 11. Which of the following best defines the term ceding commission in a reinsurance contract? A. The amount paid by the reinsurer to the ceding insurer for managing the claims process. B. The amount paid by the ceding insurer to the reinsurer to cover the cost of premiums. C. The percentage of premiums paid to the ceding insurer by the reinsurer to compensate for acquiring and servicing the reinsured policies. D. The fixed amount paid by the reinsurer to the ceding insurer as a lump sum settlement in case of large losses. Answer: C. The percentage of premiums paid to the ceding insurer by the reinsurer to compensate for acquiring and servicing the reinsured policies. Explanation: Ceding commission. This commission is typically a percentage of the premiums that the reinsurer pays to the ceding insurer to cover the expenses incurred by the ceding insurer for acquiring and managing the reinsured policies. Claims process management. While the ceding insurer might be involved in handling, the ceding commission is more about covering administrative expenses, not claims management. Premiums. The ceding commission is paid from the reinsurer's share of the premiums, not from the ceding insurer's payment to the reinsurer. Question 12. Which of the following is a characteristic of non-proportional reinsurance? A. The reinsurer shares premiums and losses based on a fixed percentage. B. The reinsurer only pays for losses that exceed a predetermined amount. C. The ceding insurer retains all of the risk for claims below a certain level. D. It is primarily used for low-frequency, high-severity events. Answer: B. The reinsurer only pays for losses that exceed a predetermined amount. Explanation: Non-proportional reinsurance. This type of reinsurance, like excessive loss, involves the reinsurer covering only the losses that exceed a certain threshold or retention level. The ceding insurer retains the risk for losses up to that threshold. Proportional reinsurance. In contrast, proportional reinsurance involves sharing both premiums and losses on an agreed percentage. Question 13. What is the purpose of a deductible in a reinsurance agreement? A. To reduce the reinsurer's liability by limiting coverage for smaller losses. B. To ensure the ceding insurer retains portion of the risk for losses under certain amount. C. To require the reinsurer to pay for losses that are lower than a predetermined threshold. D. To eliminate the ceding insurer's responsibility for certain risks. Answer: B. To ensure the ceding insurer retains a portion of the risk for losses under a certain amount. Explanation: Deductible. A deductible is the amount the ceding insurer must pay before the reinsurer becomes liable for losses. It serves to retain some level of risk with the ceding insurer and prevents them from passing on every small loss to the reinsurer at low losses. Deductibles are typically set for smaller losses, ensuring that the reinsurer becomes involved when losses exceed the deductible amount. Question 14. Which of the following best describes a treaty reinsurance agreement? A. An agreement that covers individual risks on a case-by-case basis. B. A reinsurance agreement where the reinsurer automatically accepts all risks from the ceding insurer within the scope of the treaty. C. A reinsurance agreement that covers only catastrophic events. D. An agreement that allows the reinsurer to choose which risks it would accept from the ceding insurer. Answer: B. A reinsurance agreement where the reinsurer automatically accepts all risks from the ceding insurer within the scope of the treaty. Explanation: Treaty reinsurance. In a treaty reinsurance agreement, the reinsurer agrees to cover all risks within the defined scope, automatically accepting them without individual negotiations for each risk. It contrasts with facultative reinsurance, where risks are accepted on a case-by-case basis. Catastrophic events. While excessive loss reinsurance is used to cover catastrophic events, treaty reinsurance typically covers a broader range of risks. Question 15. Which of the following is not a function of the Maine Bureau of Insurance? A. Approving reinsurance contracts for ceding insurers. B. Licensing and regulating insurance companies and agents within Maine. C. Enforcing the solvency requirements for insurance companies. D. Developing international treaties for reinsurance agreements. Answer: D. Developing international treaties for reinsurance agreements. Explanation: Maine Bureau of Insurance. The Bureau of Insurance regulates the insurance industry within the state of Maine, ensuring compliance with state laws, approving reinsurance contracts, licensing insurers and agents, and overseeing solvency. International treaties. International treaties for reinsurance are typically negotiated by international regulatory bodies, not state insurance departments. Question 16. Which of the following types of reinsurance is most suitable for protecting against catastrophic losses in a high-frequency, low-severity environment? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Finite risk reinsurance. Answer. B. Excessive loss reinsurance. Explanation. Excessive loss reinsurance. This type of reinsurance is ideal for protecting against catastrophic losses. It only applies when losses exceed a predetermined threshold, making it suitable for high-frequency, low-severity events that could lead to occasional large claims. Quota share and surplus share. These types of reinsurance are proportional and more suitable for handling a balanced or predictable portfolio rather than extreme events. Question 17. Under a stop-loss reinsurance arrangement, which of the following is correct? A. The reinsurer covers losses that exceed a specified amount up to a maximum limit. B. The ceding insurer retains all losses until they reach a certain threshold. C. The reinsurer only covers losses once they exceed the retention amount for a specific policy. D. The reinsurer reimburses the ceding insurer for losses exceeding an aggregate amount. Answer. D. The reinsurer reimburses the ceding insurer for losses exceeding an aggregate amount. Explanation. Stop-loss reinsurance. This form of non-proportional reinsurance covers aggregate losses over a specific period. Once total losses exceed a predetermined amount, the reinsurer reimburses the ceding insurer for the excessive loss. This type of reinsurance covers individual large losses, not the total aggregate loss. Question 18. Which of the following is typically excluded from a reinsurance treaty? A. Losses resulting from natural disasters like earthquakes or floods. B. Losses from a specific high-risk policy selected by the ceding insurer. C. Losses from non-catastrophic events under a quota share arrangement. D. Losses due to general economic conditions such as inflation. Answer. D. Losses due to general economic conditions such as inflation. Explanation. Reinsurance treaty exclusions. Reinsurance treaties generally exclude losses that are not directly related to specific risks or policies, such as those due to economic conditions like inflation, natural disasters, and specific risks. Catastrophic events and certain high-risk policies are often explicitly included under a treaty, especially if they are part of a facultative reinsurance agreement. Question 19. Which of the following statements about reinsurance accounting is correct? A. Reinsurance premiums paid by the ceding insurer are treated as liabilities on the insurer's balance sheet. B. Reinsurers must report claims liabilities as assets rather than liabilities in their accounting. C. Premiums paid by the ceding insurer are recognized as income when received. D. Ceding insurers must recognize reinsurance recoverables as assets on their balance sheets. Answer. D. Ceding insurers must recognize reinsurance recoverables as assets on their balance sheets. Explanation. Reinsurance recoverables. When a ceding insurer purchases reinsurance, the expected recovery of claims paid is recognized as an asset on the balance sheet. Claims liabilities. Reinsurers report claims liabilities as liabilities, not assets, and recognize premiums as income when received. Reinsurance premiums. Premiums are treated as an expense for the ceding insurer, not as income. Question 20. Which of the following is an example of a retention limit in a reinsurance agreement? A. The maximum amount the ceding insurer will pay before the reinsurer becomes responsible. B. The amount of risk the reinsurer agrees to retain for specific policies under the treaty. C. The amount the ceding insurer agrees to cover for each individual claim before reinsurance applies. D. The total premium the ceding insurer must pay for the reinsurance agreement. Answer. A. The maximum amount the ceding insurer will pay before the reinsurer becomes responsible. Explanation. Retention limit. This is the amount of risk the ceding insurer retains before the reinsurer takes over. It is often used in both excessive loss and stop-loss reinsurance arrangements. Reinsurer's agreement. The reinsurer's responsibility is triggered once losses exceed the retention limit up to the limit defined by the reinsurance contract. Question 21. Which of the following best describes a retroactive reinsurance agreement? A. A reinsurance arrangement where the reinsurer covers losses from future claims. B. A type of reinsurance that applies to claims incurred before the reinsurance agreement was written. C. A form of reinsurance that only covers catastrophic events that occur in the past. D. A reinsurance agreement that covers both losses and expenses associated with a specific policy. Answer: B. A type of reinsurance that applies to claims incurred before the reinsurance agreement was written. Explanation: retroactive reinsurance. Retroactive reinsurance is used to cover claims from periods prior to the reinsurance agreement. It is often used to manage legacy liabilities from previous underwriting years. Future claims. Standard reinsurance agreements cover future risks, not past claims. Question 22. Which of the following best describes a facultative reinsurance agreement? A. A reinsurance agreement that automatically applies to all policies written by the ceding insurer. B. A case-by-case reinsurance agreement where the reinsurer accepts or rejects individual risks. C. A reinsurance agreement where the ceding insurer retains a larger share of the risk. D. A reinsurance agreement where the reinsurer is required to accept all risks offered by the ceding insurer. Answer: B. A case-by-case reinsurance agreement where a reinsurer accepts or rejects individual risks. Explanation: facultative reinsurance. This type of reinsurance is negotiated on a case-by-case basis. The reinsurer has the option to accept or reject individual risks presented by the ceding insurer. Treaty reinsurance. In contrast, treaty reinsurance involves automatic acceptance of risks within the terms of the treaty. Question 23. Which of the following best describes a surplus share reinsurance agreement? A. The reinsurer assumes a fixed percentage of all policies written by the ceding insurer. B. The reinsurer agrees to cover only the portion of the risk that exceeds a predetermined amount. C. The ceding insurer retains a larger share of the risk for smaller policies. D. The reinsurer shares the risk proportionally with the ceding insurer based on the size of the policy. Answer: D. The reinsurer shares the risk proportionally with the ceding insurer based on the size of the policy. Explanation: surplus share reinsurance. In this agreement, the reinsurer and ceding insurer share the risk proportionally. The amount of risk ceded depends on the size of the policy relative to the ceding insurer's retention limit. Quota share reinsurance. Unlike surplus share, quota share reinsurance involves a fixed percentage of risk being regardless of the size of individual policies. Question 24. Which of the following is not typically a responsibility of a reinsurer under a reinsurance agreement? A. To pay for claims that exceed the ceding insurer's retention limit. B. To assess the risks of individual policies before acceptance. C. To set the premium rates for the policies ceded. D. To manage and settle claims on the original policies under the reinsurance arrangement. Answer: C. To set the premium rates for the policies ceded. Explanation: reinsurer's role. The reinsurer is responsible for paying claims exceeding the ceding insurer's retention limit and managing the reinsurance contract. However, the ceding insurer typically sets the premium rates for the original policies, not the reinsurer. Reinsurer's involvement. While reinsurers may have input on underwriting standards, they do not generally set premiums for underlying policies. Question 25. What is the primary purpose of a loss portfolio transfer agreement in reinsurance? A. To transfer future claims risk from the ceding insurer to the reinsurer for a set period. B. To reinsure a portfolio of policies to prevent insolvency of the ceding insurer. C. To transfer liability for existing claims to the reinsurer, often in the context of runoff liabilities. D. To allow the reinsurer to manage claims on behalf of the ceding insurer. Answer: C. To transfer liability for existing claims to the reinsurer, often in the context of runoff liabilities. Explanation: loss portfolio transfer. This agreement allows the ceding insurer to transfer liability for existing claims, including those in the process of being paid or in reserve, to the reinsurer. It is often used to manage runoff claims. Future risk. Loss portfolio transfers specifically deal with claims already incurred, future risks. Question 26. Which of the following is an example of per occurrence excessive loss reinsurance? A. A reinsurer covers a percentage of all claims arising from a single event. B. The reinsurer pays claims that exceed the ceding insurer's retention for each claim. C. The reinsurer covers the total losses from an event after the ceding insurer's retention is met. D. The reinsurer covers the aggregate losses of portfolio over specified time period. Answer B. The reinsurer pays claims that exceed the ceding insurer's retention for each claim. Explanation: per occurrence excessive loss. This type of reinsurance is designed to cover individual claims that exceed the ceding insurer's retention for each specific occurrence, rather than aggregate losses over time. Aggregate coverage. An aggregate excessive loss covers total losses over specified period, not individual occurrences. Question 27. Which of the following best defines fronting in reinsurance? A reinsurance arrangement where the ceding insurer retains all risks but uses the reinsurer for administrative purposes. B. A reinsurance agreement where a primary insurer issues a policy and then cedes it to a reinsurer, typically in another jurisdiction. C. A type of reinsurance where the reinsurer assumes all the risk for the policyholder. D. A reinsurance strategy involving the ceding of only the most profitable policies. Reinsurer. Answer B. A reinsurance agreement where a primary insurer issues a policy and then cedes it to a reinsurer, typically in another jurisdiction. Explanation: fronting. This is a practice where an insurer, often in one jurisdiction, issues a policy and then cedes the entire risk to a reinsurer in another jurisdiction. The primary insurer is essentially acting as a front for the reinsurer. Risk assumption in fronting arrangements: the reinsurer most of the risk while the ceding insurer retains minimal exposure. Question 28. Which of the following is a key advantage of using reinsurance for an insurance company? A. It guarantees a profit for the ceding insurer. B. It provides a way to diversify risk and protect against large losses. C. It eliminates the need for the ceding insurer to manage claims. D. It allows the ceding insurer to avoid paying premiums. Answer B. It provides a way to diversify risk and protect against large losses. Explanation: reinsurance. One of the primary advantages of reinsurance is that it helps insurance companies manage risk by transferring a portion of their exposure to reinsurers. This protects the ceding insurer from large unexpected losses. Claims management. While reinsurance can affect the management of claims, it does not eliminate the need for claims managed by the ceding insurer. Question 29. What is the main objective of regulatory reporting for reinsurance companies? A. To reduce the amount of capital required for underwriting. B. To ensure transparency and solvency of the reinsurance company. C. To maintain confidentiality of the company's financial information. D. To allow the reinsurance company to avoid paying taxes. Answer B. To ensure transparency and solvency of the reinsurance company. Explanation: regulatory reporting. Reinsurance companies are required to report their financial information to regulators to ensure they remain solvent and can meet their obligations to policyholders. Transparency in reporting is crucial for maintaining trust and financial stability. Capital requirements. While reporting helps in managing solvency, the main goal: transparency and solvency, not reducing capital requirements. Question 30. In a reinsurance contract, which of the following best defines the term retrocession? A. The ceding of risk by the original reinsurer to another reinsurer. B. The payment made by the ceding insurer to the reinsurer for covering their risks. C. The distribution of claims among multiple reinsurance agreements. D. The agreement to assume liability for existing claims rather than future risks. Answer A. The ceding of risk by the original reinsurer to another reinsurer. Explanation: retrocession. This refers to the process where a reinsurer passes on or cedes part of the risk it has assumed from the ceding insurer to another reinsurer. It is the reinsurance of reinsurance. Liability and claims. Retrocession does not deal with existing claims or direct payments between the ceding insurer and reinsurer, but with transferring risk from reinsurer to another.